With Donald Trump making a return to the White House, one thing is on everyone's mind: tariffs. If history is anything to go by, we might see a return of tariffs on imports, especially from major trading partners like China. But what would this mean for the US economy? Could these tariffs drive up inflation and force the Fed Reserve to keep rates high, even as they're trying to bring it down? Back in his first campaign, Trump's administration introduced tariffs to reshape the American trade balance. These tariffs, essentially taxes on foreign goods, meant that imported products cost more, putting pressure on industries that rely on these imports for raw materials, components, or even finished products. From electronics to automobiles, many industries felt the impact. When the cost of imported materials rises, companies have two choices: absorb the cost or pass them on to you, the consumer. As a result, consumer prices on everything, from appliances to cars, went up. Now, this is what we would call cost push inflation, where increased cost of production pushes prices higher. Let's break down how cost push inflation actually works. Imagine a electronics company that imports components from overseas. When tariffs increases the cost of these components, the company has no choice but to raise prices on its products. And it's not just electronics. From tech to agriculture, rising input cost hits almost every corner of the economy. When companies can't avoid passing these costs on to consumers, we see prices going up across the board, and that's inflation. Now, this is where the Fed Reserve comes into the picture. The US Fed Reserve has two key mandates: keep inflation in check and maximize unemployment. In recent years, the Fed Reserve has been carefully cutting rates to support economic growth. But tariffs introduced a more unique challenge. Unlike demand driven inflation, where people are spending more and pushing prices up, cost push inflation originates from the supply side. So even if the Fed raises rates, it won't directly lower the cost of imported goods. So why are interest rates such a big deal? Higher interest rates makes borrowing more expensive for everyone, from businesses looking to expand to individuals buying cars or homes. Now, if you're looking to level up on your forex trading experience, you've got to check out 8cap. 8cap makes forex trading smoother by giving you access to competitive spreads, reliable execution, and all the tools you need to take your trades to the next level. Gone are the days of hidden fees and frustrating platform limitations. 8cap takes the hassle out of trading, just so that you can focus on making the most out of every market opportunity. Ready to get started? Just click on the link in the description below. Registering an account with 8cap can be done in minutes. To begin, choose your Google account or an email address. Input your email address and decide on a password. Next, select your country of residence, fill in your full name and contact number. You will receive an email to verify your email address. Once that's verified, proceed to fill in your personal details and choose your preferred trading platform, account type, and base currency and leverage. Read and agree to the legal documents and declaration to complete your application. Remember to submit your proof of identity and proof of address. Once your application has been confirmed, you'll be ready to start trading with 8cap. When borrowing cost rises, people and companies slow down on spending and investments. This can cool off demand, but also risks slowing down the economy a little bit too much. Higher rates mean that businesses might cut back on hiring or even freeze new projects altogether. So here's the real question: Could tariffs lead to inflation that keeps rates high for longer? If tariffs drive inflation higher than expected, the Fed Reserve may have no choice but to keep rates elevated. While this might control inflation in the short run, it could also weigh down on economic growth and job creation. In other words, tariffs could force the Fed Reserve into a balancing act, keeping inflation under control without pushing the economy into a slowdown. It's going to be a tough spot, and one that could have consequences for everything from household budgets to corporate earnings. Now, let's look at some possible scenarios here. If tariffs introduce significant inflationary pressure, the Fed Reserve could keep rates high to manage inflation expectations, like we talked about. For consumers, this would mean continued high borrowing costs, potentially for years to come. The government could also consider other measures, like targeted subsidies for impacted industries or removing tariffs altogether. I don't think that's going to happen with what Trump has been saying. Or that could ease supply side pressures. And these options could or may help balance inflation without relying solely on rate hikes. Another approach could involve promoting local production or creating incentives to stabilize supply chains. While this wouldn't have an immediate effect, it could create more long term stability in prices. So, what does this all mean for you? Tariffs might seem like an abstract policy decision, but they can have real, massive consequences on your financial life. If tariffs push inflation up, you may find yourself paying more for everyday goods. Borrowing for big purchases might stay expensive, and companies could or might become more cautious about hiring and expanding, which will affect job opportunities. The return of tariffs and the impact on inflation and interest rates is something every consumer, investor, and business owner needs to keep an eye on. In a world where economic policies can shift quickly, staying informed is the best way to be prepared. So, what do you think? How will tariffs shape the economy in the years to come? Let me know in the comments below. And if you found this video helpful, be sure to subscribe, like, and stay tuned for more insights.